All right. So another week. Today we're going to actually talk about mutual funds, which is just kind of, well, typically mutual funds are made up of stocks. So we've kind of covered the underlying financial instruments, but to tell you the truth, mutual funds could have other investments in them. It could be bonds, it could be whatever. 95% of them are stocks, equity. And this is something that you're probably already involved in. You may not know it, but you think you've got a 401k or whatever program already set up for retirement with someplace you work. And if you look at the underlying assets in there, it's probably mutual funds, because that's a good thing. Mutual funds are, you're experiencing the stock market, the gains that are possible. This is that chart that I've talked about a few times that shows the pattern of stocks. It's definitely an eye chart. It only goes through about 2014, but you can see it's an upward vector. Sure, the right there, we can kind of figure out where the Great Depression was, right? And then a little glitch here in 2007. But if you're I don't want to be pejorative here, but if you were less than smart, it's horrible, I'm out. And boom, you got out right here. If you just would have not panicked, been a little patient, yeah, I've got a different computer tonight that's got a touchpad. I hate it. But anyway, you can see that after a couple of years, it jumped right back up. So, slow and steady. It's not something especially for retirement accounts and things like that. You're typically not jumping in and jumping out. If you stay with the program, you'll be all right. Now, also that's interesting is this is the Dow. When people talk about how the Dow is doing, they're talking about the Dow Jones Industrial typically. And what that shows is this is a indice that's made up of a lot of different companies. Because if somebody were to say to you, how's the market doing today? Well, there's going to be some winners and losers, but you're interested in kind of the overall trend if you're asking how the market's doing. So a long time ago, they came up with indicators that have a selection of stocks that's represented, and that sort of shows a sort of a cumulative, aggregate indication of where the market's going that day. So the Dow is only one indicator. And to tell you the truth, I probably wouldn't want to be deeply invested in the stocks that Dow holds, because you would have missed out on a lot of growth that happened in the tech sector and other things that aren't even represented in the Dow. So anyway, investing in mutual funds. Oh, try and get this thing to work. So background, stock mutual funds, right? So what's going to happen here is there's the stock market and there's individual stocks, and to come up with a more user-friendly product, a more sort of less volatile product, they form a fund. A company will purchase positions in a whole bunch of stocks and then offer them to you for sale. And so that's their thing. They have a fund manager, and they have typically quite a few different funds, and they offer them to the public, and they can do that pretty well. So we've got a little racket go to the background, but we'll bear with it. If I stop, they'll just make it worse. Bond mutual funds, so same sort of thing. A mutual fund that's comprised of bonds. Now, this business of professional portfolio managers, yeah, sometimes those guys are like coaches, where they put a lot of research in, and they, pardon me, will have a bunch of different positions, and they'll buy and they'll sell and they'll jump in, they'll jump out. The market that we had for the past 20 years or so has been pretty steadily going up. And a lot of these people who think they can outguess the market and time things, frankly, they've been wrong more often than they've been right. And so that's what the homework assignment will be. And it'll be a comparison of it's just a podcast that you'll listen to. It's about 20 minutes long or so, but it's a bet that was done between a guy named Warren Buffett and the guy from Vanguard. Anyway, big investment guys, and one guy takes the position that an actively managed fund is going to do much better than an index fund. If you have an index fund, let's say you come up with an index like the Standard & Poor's, 500. That's a index that's made up of a whole bunch of stocks that represent the market. And if you're going to do an index fund, let's say you buy some whatever, 100 shares of each company represented in the Standard & Poor's 500, and you just buy and hold and you forget about it. No trading, no management to say, once you do the purchase, you just buy and hold. And so somebody who wants to buy into that fund, you can do that, but there's not a high profile manager. There's none of this stuff. There's not a lot of expenses associated with it, because those funds that trade a lot and try and outguess the market and spend all this time and money on research, well, all those costs have to be paid for, and they're calculated into your return. They're subtracted from your return. And so that's where a lot of people are of the opinion that that's just kind of a waste of time. They're churning. They're treading water really fast, and they're not getting anywhere. And buy and hold. The market's slow and steady. It's going to do well, and you don't have to put that much effort into it, and you can keep the expenses low. So anyway, you'll know all about that after you listen to the podcast. Motives for investing in mutual funds. So a lot of this had to do with some of the hurdles that were kind of artificial that existed in the stock market, because they didn't really have a lot of technology involved. You make an order and you call a broker, and it'd be an even numbers of shares, and there were commissions, and it was just really cumbersome. Now, with a lot of the online trading, some of these advantages have kind of gone away, and they will let you have smaller investments. Now, this portfolio manager, the expertise of the portfolio manager, you can argue both ways on that. And to meet specific goals, everybody's kind of has specific goals, but sometimes the mutual funds will, for example, they'll have these what they call life cycle funds, and there may be different branding, different marketing names. But what they'll do is it'll be, say, a retirement fund that's set up for you to retire in, 2065 or something like that. And so it'll be a series of investments that are going to target this, date that you've set of 2065 for your retirement. And they're going to have you in aggressive investments early on. And then as this 2065, day is approaching, they'll put you in more conservative investments, because, you're getting close to retirement and you have less time to deal with volatility if a market crash were to happen. And so there's some stuff that can go into that's valid. Now, another thing is the net asset value. That's just the same as the stock price. But since these stocks hold so many different investments, it's hard to come up with a single value. So that's what they're doing. They have all these different positions, and they go ahead and calculate a price at the end of the day, typically at the end of the day. So that was also a difference between the stock market and mutual funds, because mutual funds had so many positions across so many markets. What they would do is they would only calculate the price once a day, whereas the stock market's zooming up and down and people are jumping in, jumping out. Mutual funds are meant to be not jumped in and jumped out of very often. In fact, a lot of times they'll limit you, they'll penalize you if you do that. Their theory is that you've got this fund manager who knows how much money he has to deal with. And so that means that the investors should be fairly stable and not jumping in and out of positions. And so they really frown upon that. If you're in a mutual fund, they like some stability, like you to get in there each day. But in terms of checking the price, the net asset value, that same sort of charting mechanism that we saw for stocks, that all applies. So all the cool tools with the seeing what the volume was and everything else, it's all the same. They have a ticker symbol, and it's all easy to do. But typically the values are just calculated per day. But most people, mutual funds are not meant to be traded intraday throughout the day. Okay, open-end, close-end funds, we're not going to spend a lot of time in this. Sometimes there's different ways. The problem is that they can define this different ways. There are some mutual funds that only want to get so big, and so they'll limit new investors. Then there's also, it can just be expressed different ways. But for example, there was a fund called Fidelity Magellan, and then also some of the ones that are owned by the gentleman from Omaha, who's part of the podcast, Warren Buffett. He also has some funds, Berkshire Hathaway stuff, where they've already got enough investors. They've got a big pot of money, and because they get such high returns, a lot more investors would like to jump into that. Well, a fund can get too big. Let's say there's a small company and you've got this big mutual fund and they want to take a position in this new company. They're the elephant in the room. If they invest in that company or even show interest in that company, the stock price for that company is going to be distorted. It's going to get all screwed up, and it just gets to be too cumbersome. So a lot of times companies will limit the size of their mutual funds. Now you can also do some of these proprietary funds where they have a front end load and some other things, or privately held mutual funds. It's a strange thing where they're they're only offered through a specific company. Those things are all becoming kind of the minority, the very small fraction of mutual funds that are traded. Most mutual funds, you go on whatever exchange and you can buy one company's mutual funds on another company's sites, because these sites are smart. They know that you're looking for the highest overall return, and they would like you to do all of your retirement business, let's say, through their company. And if you as the investor say, well, I like this company, but I can't get such and such investment, it's offered by one of your competitors. A lot of these companies will, as a convenience, offer their competitors' mutual funds through their site just to keep you on board, keep you in the same place. So, yeah, closed-end mutual funds. Again, don't get too wrapped up about this. I'm not going to test anything on this because a lot of the stuff is it's proprietary rules, marketing stuff that's not as prevalent. Premiums and discounts and no. We're those are all down in the exceptions category that we're not going to spend a lot of time with. This is a big deal, and this is why all those complexity of those previous things are just not important. So you've got what you call load versus no load funds, meaning a commission charged or no commission charged. Well, obviously, again, in investing, you want all of your money working for you. If you can avoid paying a commission with the money that you're investing, especially money that you're not going to touch for 40 to 60 years, you certainly don't want to pay a commission. And mutual funds are not that complex. You don't need to. You need to read a prospectus, or it's basically like an end user license agreement, like a computer type thing. But it's basically the rules of that particular mutual fund, and that's it. And then you can buy that mutual fund. So a salesperson, a commission guy is not your friend, not necessary in this case. In 99% of the cases. So you're looking for a no-load mutual fund. And these people, just because they're no-load, doesn't mean they're, strictly, they're not going to talk to you. They're not going to give you information and all that stuff. They're going to be super helpful. They're just not paid on commission, because if they were paid on commission, you would go somewhere else. It's a competitive market out there. So the no-load mutual funds, especially in the age of the internet, have kind of gone by the wayside. Loaded mutual funds are, sold by a stockbroker or somebody else, or, there's certain companies. It may be different in your industry, but I can tell you in the military, there was certain organizations that sort of preyed on service people, and they'd give you a free, lunch and take you to dinner and do all this stuff and sell you loaded mutual funds. Well, you would have been far better off buying your own dinner and getting your own stuff. So, loads can have a significant impact on investment performance, is the gist of it. So no load is what you want and what you can find. And this is an example. So this guy, because he paid a load up front, his return went from 10%, very nice, to 5.6%, not so nice. Just barely above inflation, or below current inflation. Oof. Anyway, background on mutual funds. More of that. Okay, so the expense ratios. This is where, you want to look at the yield. You want to look at a company called Morningstar. Morningstar is, like I've talked about, if you're looking for insurance products, there's rating agencies for that. You've got Fitch, you've got Standard & Poor's, you've got different companies that do bonds. You've got Morningstar. They don't necessarily have their own mutual funds, but they rate other people's stuff. And their reputation, they make their money by providing objective advice on mutual funds. So my point is, this fund has got a very high expense ratio. They're charging a lot for the operation of the fund. That's important. But what's more important is their overall yield. How much, it's a coach that's paid, so many, well, everybody's paid $1 million, I guess, in the coaching world. But the guy that's paid $10 million and the other guy's paid $1 million, you're not necessarily going to go with the cheaper coach. You're going to go with the one that's winning. So if one fund has a higher expense ratio, but it's getting a great return, the person in managing that fund is probably worth it, Now, if they're getting crummy performance and they're charging high fees, that's when you have to go someplace else. So again, though, you have to, just like sports or whatever, you have to look at trends. You want to be forward looking. They did well last year, and but is that same fund manager there? Did he switch companies? Did he? You need to do a little due diligence to invest in it. So a high expense ratio isn't necessarily a disqualifier, but a high expense ratio that's not showing stellar returns, well, I'd go with the lower one, or perhaps you might go with a index fund that's going to have very low fees. So you've got all these fees that are pushed in there, portfolio management, 12B-1 fees, all these different fees that cover all the admin and the other expenses that go into a fund. But what you're concerned with is the bottom line at the end. If there are returns with all of these fees subtracted, is it still a high performing fund? Yep, so this is what they're trying to say. Relationship between expense ratios and performance. Funds with lower expense ratios tend to all things being equal, if everybody's earning, say, 10% on their investments and, one fund only has a 1% expense ratio and the other one has 3%, yeah. But if, again, you understand what I'm talking about, if the one's getting 15 or 20%, they can, maybe that team they've assembled to manage that fund is worth their money. Types of mutual funds. whatever you want. There is somebody out there with a fund. There are more mutual funds than there are individual stocks. There are more mutual fund offerings than there are publicly traded companies. So, if you want something that's environmentally friendly, dealing with emerging Pacific Rim high-tech growth, you can find a fund. I guarantee you. There are, they have sector funds that, let's say, you're interested in, you think the defense sector, you think the medical sector, you think the high-tech, industry is blown up, whatever you think is going to happen. You could find a fund that will cater to that. They can be done geographically. Like I said, you could find one that caters to some region of the world. You can find, for example, there's international funds, which mean they could invest everywhere except for the United States. If you want to invest everywhere to include the United States, then you're looking for a global fund. I mean, it's just there's so many offerings out there, and again, though, I would typically look at the yield. Who's doing well? There's a lot of times where common sense kind of it's very frustrating sometimes when you're watching the stock market. You'll see great jobs numbers come out, and the stock market goes down, and you're like, wait a minute, that doesn't make any sense. Well, then you look, and it's because of that means that labor cost is going to go up, or it means that the market expected an even better report, and this one's, even though it's great, it's a little less than what they forecast, and it's a really tough business to try to outguess the market on the way things will go. But a couple categories they have here. They have a growth fund and a capital appreciation fund. Certainly those are some. And then you've got, large growth funds. You've got small cap growth funds, meaning capitalizations, and there's different characteristics for that. You've got income funds. You've got funds that, an income fund will hold larger mature companies that are paying a dividend, that aren't necessarily expanding. These growth funds, for example, you would not expect to get a dividend from them because the companies are growing. They're getting their profits and they're reinvesting into new buildings and stuff. So, again, there's a lot to it. As I've kind of alluded to, from a investment strategy, when you're young, theoretically you should be investing in higher tech stuff. As you get older, or not higher tech, but higher growth stuff, which might correspond to higher tech stuff. Right now, not so much. But anyway, and as you get closer to retirement, you should be in more conservative type investments and maybe income things. But for every rule, there's an exception. I was in super aggressive stuff, and I didn't necessarily get burned too bad, but man, the market was cranking. It was not the time to sit on the porch. To get real conservative for the past 10 years, you would have missed out on a lot of growth. So small cap, mid cap. So again, there's numbers that go along with this in terms of how many millions or billions it takes to be called a small cap, a mid cap. But just think smaller companies, middle-sized companies. Equity income funds, so that's one that's going to be paying a dividend. So those are going to be large. So it's actually sort of a progression what they have there. Small, mid, and then they don't necessarily say large cap, but a large company like that is probably one that's larger, established, and paying dividends. So it's fairly linear. Balanced funds. I mean, come up with whatever you want, and it's probably out there. And again, if you want to invest, internationally, if you want to, invest in the BRICS, for example, Brazil, Russia, India, whatever, all the countries involved in that, you can find a fund that would cater to that, and it will the fund manager and the traders and their accountants have to deal with all the currency issues, all the exchange, issues, all the regulatory problems. But you're investing in this, third world country that you typically would not be able to. Not that all the BRICS are third world, but anyway, you know what I mean. Sectors, though, but sectors can be split up however they want. They can be, specific industries, but they can also be regional. Index funds. So I mentioned that a little bit before. Mutual funds attempt to mirror the movements of an existing index. And it's just an easy mechanism to buy. These indexes are selected. The function of an index, the utility of an index, is to provide an indication of the general way the market is moving. So when somebody's setting up an index, they'll take a broad range of stocks from across, the whole range. And so from an investment strategy, if you owned a portion of all of those broad range of stocks, you'd have pretty good diversification, pretty good resiliency to what you don't want to have happen is you don't want to have all your eggs in one basket. You don't want to be 100% in, say, a company like NVIDIA. NVIDIA makes graphics cards, and they're probably going to do super well because they did, they were a great card for, Bitcoin mining and things like that. So they did really well, and now they're doing really well in AI. But let's say there's a competitor that emerges and knocks NVIDIA down. You were right on your overall guess that sector was going to go way up, but you refined it into just a single company. You might have been better off by having more diversification, and you can take that diversification to a further extent by going across an entire index. Now you're not just in one sector, you're not just in one region, you're across the whole thing. So that's why people do that. International stock funds, I talked about that. That means outside the U.S. Global would be everywhere, to include the U.S. Socially responsible. Yeah, you can certainly find ones that won't invest in certain companies or countries or don't do certain investments, but it's a complex path. I mean, take EVs, for example. People want to invest in electric vehicles because they're great for the environment. Then you look a little deeper and it's like, well, wait a minute. Who's mining these batteries? And where do the batteries go when we're all done with them? And whatever else. A lot of these issues are, you again have to do some due diligence. If you really want to try and do something with no harm, you have to look at the unintended consequences, which is things are more complex typically than they would once appear. Other types, yep. Now this other thing, this ETFs, exchange traded funds, this is sort of where, the exchanges want to get right back into it, and they want to sell not just stocks, but they also want to sell, funds directly, and fair enough. And these ones are more like, you can jump in and jump out of them. They're mutual funds, but they're meant to be traded and probably with commissions, maybe a little bit, but anyway, it's a way for them not to be locked out. That whole the exchange where they can directly offer products. Different companies. Vanguard's certainly a good one, but for me, if I was in your situation, your company, and maybe you'll be self-employed and you'll choose a company, but if you're working for, say, State of Alaska, or, well, I know the University of Alaska, they had different vendors, different brokerage firms that they dealt with, Fidelity, and I think maybe not T. Rowe Price, but there's also one that caters to educators, and anyway, different funds, different companies, and so it kind of made sense to be associated with that company rather than have 5 different, financial services companies big brokerage things. I'm talking, this is separate from the banks, but the big full service brokerages, they're all pretty good. And so for simplicity, if the place where you're working has, Vanguard or Fidelity or T. Rowe Price or Ameritrade or whatever, they're all very competitive. They all offer similar products. And anyway, look at them when you're working on your term paper, as you should. Number one, they're a great resource. Any of those companies, because they want people like you. They want people, they're going to spend a lot of time, a lot of marketing on new investors, because once they get you in, they're going to have you for life. And if you don't already have a brand loyalty, they can, maybe bring you in. It's like beer or anything else. I mean, they don't waste any money advertising beer to 40, 50-year-old people. Those people have already set in their ways about what they like and what they do. They're looking for the younger demographic that's malleable. So all these sites are going to be tailored to focus on things that will help you out, and retirement calculators and other things that you'll be thinking about and you might use for your papers. On bond funds, again, these ones here, the Treasury bonds are going to be, it's risk versus reward. So the U.S. Treasury is not a very risky investment, so don't expect those bonds to outpace inflation. Ginnie Mae, now we're talking about funds that are, involved in the mortgage business. Again, those, not a, bad investment, but again, real estate is fairly safe, and the risks that you're going to be taking in terms of a bond, the yields are going to be probably, a little bit lower. Corporate bonds, these could be all over the place. There's high quality ones, and then there's junk bonds. Not all corporations are the same, so the default risk is varies amongst them. So you have to do a little bit more research on corporate bonds if you're interested in bonds. So yeah, high yield sounds good until you see in parentheses junk. So municipal bonds, again, they're government bond, usually for projects. If you're in a, maybe a high wealth individual and you've got a higher tax load, municipal bonds might be more advantageous for you. The higher you're paying in taxes, the more advantageous, because typically munis is what they call them, are typically free of federal tax. And then index bond funds. So that'd be the same way stock bond funds are done, where they have more of a selection and some diversification. International bond funds, global bond funds. So same. And classification. So again, not all mutual funds are stocks. There are probably 5% maybe that are bonds, and another 1% that are something else, maybe precious metals or something like that. Risk and return. It depends on the underlying assets. You can't say, oh, mutual funds are risky. They're if you dig into the mutual fund, you'll see the stocks that they own, and that's where you have to make the determination. So that's why we talked about stocks, last week, and kind of looking at and how to evaluate stocks and kind of figuring out, you might have more gut instinct about, oh, that's a great company, that's not a good company, and maybe do a little bit more research than just, your own opinion. But anyway, you have to know what the underlying companies are. Typically, dividends, I always just check the block to reinvest. Same thing with capital gains. If they sell stocks underneath that mutual fund, you would get a little bit more mail at the end of the year, and have to pay taxes on that or just get it reinvested for the most part. They could also, if you redeemed any shares, that would also generate capital gain. So capital gain means, you bought something for $20, you sold it for $30. You had a $10 capital gain. It's just another word for. There's probably some definitional difference between capital gain and profit, but for most of us, it's profit. It's synonymous. Short-term capital gain, long-term capital gain, total income, taxes on dividends, taxes on short-term. So again, this long-term, short-term, a year is the break point there. If you keep things for longer than a year, you'll pay typically around 15%. If you keep it shorter than a year, you'll pay it at whatever your tax rate is. And so in this case, they're saying about 28%. Risk from investing in a mutual fund. So, market risk. Now, it's going to be, the reason why you're in the mutual fund is to get that diversification. You're not tied to just a single company. You've got a broader range. But if the whole market goes down, so goes you. So, trade-off between expected return and risk. Risk is not a bad thing. Risk is what's going to get you higher yields, a higher return on investment. So, no risk is going to be, virtually no return, and inflation is going to eat it up, and you're not going to build the nest egg. Now, what you want to make sure is that, and this is where, Morningstar or the stock research or whatever you're doing, you want to make sure that there's a direct linkage between the amount of risk you're taking and the return you're receiving. Because they don't necessarily have to be linked. What I'm saying is there might be some investment that's incredibly risky and is only returning about 5%. That's not going to work. You want to make sure that the risk and the return are commensurate. Ideally, you want something that's very low risk with a very high return, but that's not typically the way the market works. So moderate, high risk, So, growth stock fund in one sector. So they're saying, a growth stock company that's growing, in Silicon Valley, even back in the good days, 9 out of 10 failed companies. So you don't want to necessarily be tied to a single company. So again, diversification. Growing companies are more volatile. And if you're in a mutual fund that only is looking at one sector, well, then that's a higher risk. They're not all in one company, but they're only in one sector. Risk investing from bond mutual fund. Companies can default, so you have to know what the underlying assets are. So this is what they're saying. So an index fund, trade-off between risk and return. I don't necessarily agree with this totally, because this index fund, there's some index funds that are tied to exclusively growth stocks. Anyway, moving on from that, they've got an income fund that contains stocks that pay higher dividends. So it's going to be a little higher risk and a little higher potential return. And now we start getting into the growth, and we start getting into small growth, and now we're just in a particular sector, technology, which is known to be volatile. And now up at the top, we're into a foreign company focused on one small country. So again, it's tough to, the charts there's always exceptions, but again, getting back to the electric vehicle type stuff. If there's a new battery technology and that mineral is located exclusively in one country, there's probably going to be some explosive growth. But if it's a country in a region known for political instability, there's some risk there too. So you can the United States. There's a reason why a lot of money flows into the United States. Is for safety, for politically stable countries tend to do well, whereas some of the foreign, especially some of the smaller ones, can be quite a bit more volatile. When I lived in Turkey, for example, I mean, every once in a while they just come out and print new bills, and they just scratch all the zeros off. I mean, the inflation. The Turks, they just didn't hold cash. You couldn't, because it just devalued so quickly. They didn't have tremendous amounts of money in bank accounts, or if they did have those kind of funds, they would put them overseas. They'd buy U.S. bonds or whatever, so they're not denominated in the Turkish currency, in the lira that had crazy inflation. So anyway, those our economic problems are pretty trivial compared to some countries. Classifying bond funds. So again, yep, longer term, high yield. So the risky companies, and you're in there, you're locked in for many years. That's going to be up on the upper right there. Down on the lower left, short term. So you're not making when you're investing in a bond, you're sort of making a prediction about the interest rate direction, which direction it's going to go. And it's like saying, it's like making a weather forecast a month out. I could probably tell you with quite a bit more accuracy whether it's going to, rain or snow tomorrow. But to make that same prediction over the course of a month, that's pretty challenging. And that's the same thing that's going on here. And the fact that this one on the lower left is a T bond, so that's a treasury bond, so they're investing in the U.S. government. So, I'm not saying that's without risk, but there's a lot more things a lot more dominoes that are going to fall before the treasuries do. So, anyway. Yep, longer term, more sensitive. Default means the company just goes out of business flat, not paying it back. So corporate bonds typically are quite a bit riskier than municipal bonds or government bonds. So conservative short-term bond, but low return. See how the returns, conservative investments are not always the best. They're sort of a parking place to keep your money until you get it invested in something else. So would I ever buy, treasury bonds? If I thought the market was that volatile, I didn't want to deal with it, I should probably be in real estate. And that's where the money would go, investing in. And again, you can get mutual funds that invest in real estate. You have other things. You have REITs, real estate investment income trusts that do this type of stuff. So there's other investments out there. If you don't want to get involved in corporate small companies or large companies, or if you're more comfortable, there's probably a mutual fund product out there for you. Just need to do a little research. So this moderate one, real estate, most people are not going to, they're going to pay on their house. Junk bonds, that just means a company that's, could come back, might not. But anyway, in order to attract investors, they're going to pay a huge amount. I had a friend who used to get 20%. He had some private investment deal where he loaned money to a gentleman who ran a used car lot, and he'd offer financing to people. And he was paying my friend 20%, so you can imagine what the customers were actually paying. Quite a bit more in order to make it worth it. So it helps to have good credit and not end up at one of these places that can charge those kind of interest rates because you have nowhere else to go. Yep, another chart. So short term, yep, easy to forecast. Treasury bond, yep, so it's going to be low risk, low return. Out at the end, long term, not only investing in junk bonds, but you're saying that company's not going to go out of business for a long time in a foreign country, and not just a series of countries, just one country. So yeah, it's going to be a little riskier. Although, I mean, that country could be Switzerland, it could be, Norway, it could be. So again, you have to do a little more research. Determine your investment objectives, risk tolerance, decide on the fund. Prospectus. Yep. So the prospectus are kind of the rules of the road. It tells, if you invest in this conservative mutual fund because you want something just stable, and then you read this prospectus, and we're primarily going to make our money by investing in small third world countries, and we're going to do short selling and leverage this. I mean, that would not be consistent, and it would not be typically. They'd retitle the fund. These are sort of the handcuffs that are put upon the fund manager. They have to put their strategy out in paper, and then they can be held accountable for that. It's a legal document. So if they lose a bunch of money by doing a bunch of stupid trades, and you can go back and basically say none of this was authorized, this wasn't in the prospectus, this wasn't outlined as your strategy, but they typically won't do that. It's just an informational thing that tells you what their goals are, what the expected risks are, and it's just sort of the information pamphlet. But again, the company Morningstar that compares those funds is probably more useful. And then when you decide on the funds, look at the prospectus, and typically you have to acknowledge that you've read the prospectus, or at least had it presented to you before you can invest in the fund. So investment objectives, strategy, yep. Performance, fees and expenses. These redemption fee or back-end load, this is kind of another form of commission, but not as bad as a regular commission. Let's say a company says that we get 1% of your overall investment at the end of your investment when you withdraw it. That's I'd rather have them not take anything, but the fact that they're involved in taking money off of the future earnings means they kind of have some skin in the game. If your mutual fund takes off and you're make millions on it, they're incentivized to help make that happen, because that makes their back end load, that commission they get on the back end when you sell, higher. So anyway, I still don't want a loaded fund, but if it's a back end loaded fund, I'd be happier about it. Yeah, and then distribution of dividends. And again, these are typically just check boxes. What do you want to do with the dividends and any capital gains? And typically you just check reinvest, and it just makes it simpler, unless you have some specific reason. But especially when you're building up a fund, as you're starting to accumulate money in there, the first few years, you'd be, here's a check for 89 cents or something, because you wanted a distribution from the one sale. It's usually the amounts are fairly insignificant when you first get started. Minimum investment and balance. Typically these things are waived if you sign up. Let's say the beauty of mutual funds is these lend themselves to say, I want to put 10% of my salary, or I want to put $100 a month into this fund, and you just, do some sort of ACH debit or something out of my bank account, there's usually no minimum. If you're just going to do a one-off investment, it depends on the fund, but it might be something like $2,500 to start an account. But again, unless you sign up with some sort of automatic deposit program. And this is where we get into a concept called dollar cost averaging. So it's kind of a psychological thing. Market timing is very, very hard. You would ideally like to buy the dips. And with crypto, Bitcoin and stuff, to a certain extent you can, But when the stock market, it's just exceedingly difficult. And most people who do it, try to do it, they only try to do it, and they usually don't. So let's say you're just going to be a disciplined investor, and you're like, I'm going to invest $100 a month. And on the months when the market's down, guess what? I buy a few more shares of the mutual fund. And the days or the months when the market's up, I'll buy just a little bit less. I'm still buying $100 worth, but the amount of shares I'll get is going to be, the variable. The dollar amount's going to be the same. But if you do that, then it mitigates the whole ups and downs and the volatility. Some months you'll kind of win, other months you might buy at the high point, but it all sort of smooths out in the end, just because of your regular, disciplined, even dollar trade. So dollar cost averaging. How to buy and redeem shares. Everything about mutual funds is just dead easy. You just go online, you sign up your account, you might type in your bank information, and they start drafting your account, and you pick the day of the month they want to do it, and let's say you have some expense that's going on, you have some money, your car broke down, you threw $4,000 or $5,000 on your credit card, you don't want to pay that balance, so typically you do it online. They used to be almost, like everything was all done over the phone, but now it's all kind of done online. But anyway, you would just type in there that you want to sell some shares. They'll sell them at the end of the market day. They'll transfer that money into your cash account, because you'll have some sort of money market or cash management account. And boom, you just go to the little bill pay section, and you pay directly from that brokerage company and pay off your credit card. I mean, it's super. These people that's where they make their money. They're easy, they're convenient. You've got a portfolio manager that's, looking at the intricacies of the market and decided when to buy and when to sell. And you've got diversification. Mutual funds are a popular product for a lot of reasons, and most of them are good. Trading in the stock market is kind of fun. It's like sports betting, but sometimes your psychology and your tendencies get in the wrong, whatever. It gets more into speculation and further away from investment. So mutual funds are where you should probably end up with the preponderance of your wealth. Maybe real estate as well, but to have it all in the market and deal with that kind of volatility is probably not the best. Now, there's certain people. I'm not one to sit there and just watch the mutual fund. It's literally it's kind of boring, and so maybe I wouldn't keep as much money in it. So I can rationalize this by saying I'll trade individual stocks because I find it, more exciting, and I'm tempted to put more money in the market, and I make up for it. But the smarter money, I would probably have more money today had I just stuck with mutual funds and slow and steady, and you live your life and let the mutual fund company take care of that part of it. Anyway, so yeah, look at the sectors you might want to invest in, and again, the mutual fund companies can help you out. A lot of stuff. Fidelity, another great company. I've dealt with them for a while. not a problem. And back during the GameStop days, and some of these other brokerages were limiting how much their customers could buy and sell. But frankly, I didn't think that was any of the business of the mutual fund companies to brokerage fund companies to get involved in that. And so I kind of appreciated Fidelity more. And TD Ameritrade, who did limit my trades, that kind of burned some bridges with me. So anyway, but you'll develop your own preferences for different companies. Quotations in mutual funds. It looks exactly like a stock ticker. Instead of price, they'll use this NAV, net asset value, because that is the stock price, but it's just a whole bunch of stocks, and typically calculate at the end of the day. Return to date, 3-year return. They're typically looking, longer term with mutual funds. They're not meant to be traded, in and out all the time. So that NAV equates to like a stock price, how much it went up that day, year to date annual return, and 3-year return. So not bad. They're getting 10% almost. But again, I'm not looking at tab data. I'm not looking at, these comma separated values or Excel type data. I would much rather look at an interactive chart. So that's how most people are. Yep. Lipper. So, Mutual Fund Education Association, they've got their own site. It's kind of an industry standard site where they all contribute to it. But I find the individual companies just better. You can look at 6 or 8 in the individual companies, but anyway, it's another asset out there. But they're not this particular organization is put together by all those other companies. So diversification, you got to be careful with this one. There are ways to certainly diversify, but diversification, let's say you have the high growth fund with Fidelity, and you've got another high growth one with Vanguard, and you've got another high growth one with T. Rowe Price, and you think, oh, I've got diversification. Well, if they're all high growth and you look at the underlying assets, you're probably going to find all the same companies in all of those products. So diversification would be more of, I've got, because I went down in the weeds and I've invested in whatever, some investment in Vietnam, maybe I want some other investment in, whatever, some sector, the oil sector or something else, or the banking sector, or you don't. Again, you want to spread your investments out. Now, you don't want to just randomly. People have always said, "Well, you don't own," because I don't typically own any bonds. Well, bonds haven't been returning for a long time, so I'm not going to have bonds just for the sake of holding bonds. I don't want to be diversified into known losing situations, but so if there's different investments that are appealing, is a good strategy to be spread out, but don't just randomly spread into losing situations just to claim you have some diversity. No, there's got to be a strategy to it, but again, I think you understand the situation. Yep. Yeah, there's it's different sayings, and you'll see, certain sectors, like the high-tech sector, was really dependent on zero interest rates. And when that went away, they kind of tanked. But the rest of the market didn't do super well in that either. And I remember just a few years ago, people were saying, yeah, tech sector's not the way to go. Banking is where you need to be right now. Well, how are the banks doing right now? So again, you have to everything's sort of situational. And then in terms of going into other countries, the United States is still pretty dominant. You know, there's, I'm going to butcher the saying, but there's something about, you know, if United States gets a cold, the rest of the, you know, world, you know, has the sniffles or something like that. That every company, every economy is kind of a global, they're affected globally. And so you're not going to have a situation where, you know, the United States economy is going to go in the toilet. It's going to take all these other countries with it to a certain extent. And, you know, anyway, so there's a lot of interlinking that makes all of these investments kind of go up and down together. Yeah. So the international bid, it's always exciting, and you know there is potential, but there's also a little more risk because you just have more things, more moving parts, more currencies, more trade situations. There's all these, and you can go on the internet and you can find all of these experts who will tell you that, you know, oh, they've forecasted the next boom. They knew this was going to happen. They knew the stocks were going to. They say that every year, and then all of a sudden, one time it happens, they claim, oh, they guessed it. Well, you know, it's a broken clock being right, you know, once or twice a day, depending on analog or digital. Anyway, yep, talked about this, where you can generally, the hottest mutual fund, if you look online and you look at, you know, on Morningstar or something, you see who's getting the exact absolute highest return. You'll typically find that you can buy those funds through a variety of sources, not just that one company. You know, it kind of be like if you go to the Ford dealer and you want to buy a Subaru. In the mutual fund business, that Ford dealer would probably sell you the Subaru because they want you to be a Ford customer, and so they'll sell you some of their competitors' products just to make sure that your account and everything stays with that particular dealership. So the mutual fund industry works a little different than most industries. Yep. So, yeah, there are certain things. The Canadian one is kind of interesting. Canada can be the Wild West in terms of mining investments and minerals investments, and you may think, oh, this is no, it's there are some crazy volatility and some things that, you know, for you would typically expect when you think of Canada. You know, these other ones, Latin America, Europe, I just haven't seen the performance out of them, out of those sectors. But again, there's exceptions. You can get more complex type funds. You know, they start talking about hedge funds and SPACs and other things. They get more into speculations. I'm not going to spend a whole lot of, you know, there are some people who have made tremendous amounts of money in hedge funds. Where they do some very crazy, you know, sophisticated trading techniques and stuff. But and you'll hear about those, but you pretty much hear about the winners. People don't tend to talk about it when they lose everything. So there are some very wealthy hedge fund people out there, but there's also some people who've done quite poorly. So the Madoff scandal, that was the scandal of the day. Now it'd probably be the some of the crypto stuff with Bankman-Fried and stuff like that. There's always going to be scammers out there. And again, you know, the Madoff thing, though, this was a Bernie Madoff thing. He was doing a Ponzi schemes. These people were getting exceptional returns, no risk at all. Well, that can't be. You can't get, returns of 20% with no risk. And so people just didn't want to face up to it. They trusted the guy. But if they would have looked at a little deeper, it was a pyramid scheme. What you do in a pyramid scheme is you always have to have new customers. And as the new customers come in with their money to invest, you give it to your existing customers and you tell them, oh, that's the return on their investment. Knowing that, no, it's not. You didn't make any money on the investments. All you did was give the new people's money to the other people. And as long as the pyramid keeps growing and more new people come in, you can keep paying the old people, they're 20% or whatever, until you finally reach a point when you have your exit plan as the scam guy, the pyramid scheme, and you take everybody's money and you leave the country, and then they all find out. They all have a lifespan. A pyramid scheme can only last. The pyramid at some point is going to kind of collapse under its own weight. So, but yeah, people should have known, and the financial community, the SEC, and all these other people should have been aware. But things can happen. Homework. So this is an interesting thing. When they say, oh, I want the tax-free municipal bond, because it's obviously tax-free, it's going to be a better deal. Well, the tax-free municipal bond is typically going to pull a lower interest rate, right? It's not going to pay as much. So in this case, we're going through problem number one here. This guy is going to earn 10.2% on a fully taxable one, or 7.9% on one that's not going to be taxed. So the way you would figure that is if you're in a 28% tax bracket, that means any money you earn, you only get to keep 72%. The other 28% goes away in taxes. So to solve this problem, all you have to do is get that 10.2% and multiply it by 0.72, and is that number higher or lower than 7.9%? If the rate is lower than 7.9, then you're better off taking the tax exempt. If that 10.2 multiplied by 0.72 is still higher than 7.9, well then fair enough, you're better off taking the 10.2, paying the tax, and being money ahead. So that's how it works. This one here, buying some shares, at a certain price. Commission pay was $35, so you got to figure that in there. Sold it for a different price, and there's a dividend involved. So anyway, simple math problem. We talked about bonds, talked about the interest rate. If a bond is issued with a low interest rate compared to the current market, or let's say you bought this bond, it's paying 3.5%, and the new bonds are paying 5%. Nobody wants your low interest rate paying bond. So if they're going to buy it from you, they're going to buy it at a discount. It's going to make your bond worth less, not worthless. And then just another math problem. So that's easy. The podcast. So it's out there. I'll put it out on the in the sheet too. But it's getting to be kind of a dated podcast, but it's still pretty interesting. 2016, I guess. NPR, so their whole shtick, their Planet Money, I think is the show. But they go through and they explain a little bit about, what it's like with the difference between an index fund and then an actively traded fund. So that's all good. Whoops, and the term project. you know about that. Should be working on it.
Good luck.